Good morning. It's Jeffrey Christian of CPM Group. It's about 10:25 on the morning of September 22nd, a Friday here in New York. I want to talk about what comes next in precious metals. We've had a pretty interesting week in the financial markets and in precious metals. Gold and silver both dropped down to what CPM Group had as our short-term targets for our short-term trade recommendations. Platinum and palladium fell too, but they didn't hit our targets. So we've actually issued stand-aside short-term trading recommendations for gold and silver right now, and we're maintaining our gold and our platinum and palladium sell recommendations. Our expectation is that the prices could move a little bit lower, but as we're seeing today on Friday, there's a little bit of a reaction to Thursday's sell-off, and so you could see some short-term strength. Longer term, going into the fourth quarter, especially November, December, we do expect higher prices for gold, silver, platinum, and lower prices for palladium. So now you know what I'm going to be saying today. When we talk about what the market update is and what we expect to come next, that also means that you have to update your economic views and your views on competing asset markets. Now, what we've seen over the last 3 days is that on Wednesday, the FOMC reiterated the Fed's view, which it has held for months or quarters or years, that the economy is stronger than a lot of people, including the Fed and CPM Group, had expected in 2022 and in 2023, and that there is a likelihood or probability that interest rates will remain higher longer than the market wants to believe. The financial market consensus has not wanted to believe what the Fed and the ECB and other monetary authorities have been saying and doing for at least a year, and they're starting to come along to the realization that maybe the Fed and the ECB and other monetary authorities actually have been telling them what they're going to do, and they should listen to them. It's kind of funny because you hear in the gold market people who really have a bad record and a bad reputation and very little knowledge and experience pontificate about how they're smarter than the thousands and tens of thousands of economists and analysts and bankers at the Fed, at the ECB. And, it's funny, I listen to some of these guys. I know some of these guys. I try not to work with some of these guys. If I were to have my choice of a dinner companion, I would probably pick Jerome Powell over most of them because it'd be a more intellectually gratifying conversation. Anyway, over the last week, Wednesday, the Fed said, yeah, things are better. They've increased their projections for the economy dramatically this year and next year. We don't necessarily cue off of their economic projections because they don't have a particularly good track record at it, projecting markets. We tend to focus on what the IMF and the World Bank and the OECD are saying. On Thursday, we had a market sell-off, and it was across the board. Stocks were down globally, bonds were down, commodities were down, including precious metals and oil and copper and other commodities. So you had a big sell-off. Today, we've seen a little bit of return to sobriety. There's a little bit of a reality check. Thursday was a sort of a spastic reaction to the Fed's announcements and actions on Wednesday, and we're sort of settling the books before the weekend. So what comes next? Economically, we're seeing a stronger economy. CPM Group has, in fact, we do not subscribe to the view that there will be a soft landing. We do think there will be a recession. I think I mentioned in previous recent videos that we have reduced the severity of the recession that we have been projecting for 2024, 2025 in the industrialized world. We don't think it will be quite as severe because it's coming from a stronger base economically. And while there are some problems and issues that we think will come together to stimulate a recession, there's a lot of strengths in the economy and in the financial system. You're starting to hear people talk about the September effect in the stock market, and that's the fact that the U.S. equity markets tend to be weak in September. And the September effect goes into October. I remember back in 1987, the stock market peaked in September and was off 15% already by the time we got to Black Monday. And then the stock market fell, I think, another 20% or something in a day. I think it was the biggest one-day decline in the S&P 500's history that Monday in October. But it shouldn't have surprised anyone. It certainly didn't surprise us or our clients, because the stock market was already declining sharply by the time you got into that. And while it's true that the S&P and stocks in general tend to be weak in September, it's also true that the major declines had, generally speaking, occurred in October. Started off in September, but the denouement was really in October. 1929, 1987, 2008, I believe, was true. Over the past 74 years, so 3/4 of a century, since 1950, the S&P has declined more than 20%, more than 12 times. 12 times. And on average, the decline was about 33%, a third, lost about a third of its value, and regained all of that value on average 342 times, days, on average 342 days to regain where it had been. So recessions come and recessions go. Stock market sell-offs come and stock market recoveries come. If you see the stock market fall, do not sell low, because you'll wind up buying back high. That's the economic and stock market view that we expect. Higher interest rates longer, higher inflation, some structural issues there, some major changing in agriculture and service provision, increased international tensions, although there's some very interesting developments there. Political dysfunctionality in the United States increasing and becoming increasingly apparent from here for the next 14, 15, 16 months. It's very interesting because you have this impasse among the Republicans in the House, so they're going home at exactly the time when they should be chained to their desks and say, you don't go home until you fix this. And it's an easy fix, and everybody knows about it. And if people really were doing their jobs as Congress people, they would fix it easily in about an hour, but they're not. Similarly, Biden continues to go out of his way to demonstrate that he's not really a presidential timber. The Constitution says that the president has the power to bring the Congress, one house or both houses, into session or to adjourn it at his decision. So when Speaker McCarthy says, oh, we can't reach a decision even among ourselves, let alone with the Democrats, so let's go home for 8 days as the country teeters toward a government shutdown again, which is just total nonsense, a total abrogation of responsibility. Mr. Biden has the capacity to say, no, you don't go home. You sit down and you don't go home until you fix this. But he doesn't want to be president, and Congress doesn't want to be congressional. So that's where we are. That's going to be good for gold and silver. Probably won't be so good for platinum and palladium, but platinum and palladium really cue off the auto industry, and the auto industry has a strike at the big three right now, which probably will get resolved in the next couple weeks, but right now it doesn't look all that good. So there are a lot of economic and political issues that are going to play the gold and silver markets differently probably than they will the platinum and palladium markets. So here's the gold price over the last several years. Yesterday's sell-off hardly shows up because we've been in this trading range now for several months, and we're continuing to be in that trading range. We do think that the gold price has some capacity for to decline over the next week or two. But then once we get into October and especially November, we think the price will go back up and will break out of this range. We wouldn't be surprised to see the price at $2,000 or even $2,050 in the fourth quarter of this year, with higher prices projected for 2024 and 2025. Silver prices also fell sharply, and it hardly shows up on this chart. It's still in that range that it's been in, and we can expect it to continue to be in that range, 22, 22.50 on the low end, 25, 25.50 on the high end right now. Maybe into October, November, you might see 26.50, but we don't necessarily see the price going much higher than that, or 28. You know, it's in this $22 to $28 range that it's been in for much of this year, and we expect it to continue to be in that range, testing the high end toward the end of the year. Platinum has been at the low end of its range, $900 to $1,000 for most of the last several months. We expect it to move toward the top end of that range. We expect that to happen as the Big Three auto strike is resolved. There is a lot of nascent interest on the part of investors in platinum, but they haven't been as aggressive of buyers, futures, options, ETFs, physical metal, as one would think. They have been buying, there has been buying, but there's a certain hesitancy that you're seeing on the part of investors. They want to be bullish on platinum, but they're not quite convinced that that's the right posture because, quite frankly, platinum has had a lot of false starts over the last 10 years, 11 years, 9 years. And then, as I said at the beginning, we expect palladium prices to decline. They have been declining, and we expect them to continue to decline over the course of the next 4 months. That's what I have for this week. You can go to our website. You can get free reads, free videos. You can order our yearbooks. They're $160 each, and they give you a tremendous amount of information. This is this year's gold yearbook, and you can see it's thick, it's voluminous, it's charts and tables, and it will give you a fact-based, real-based, unbiased, unvarnished understanding of the gold market. And the same is true of our silver yearbook and our platinum yearbook. People pay us to get them good analysis, unbiased analysis, to be right in our expectations in the markets, not to be bullish. Take care. Take care of those around you. Be good to the world, and we'll talk to you next week.